Talking leadership, making the big plays in the mortgage game through the sun and the haze. Close more deals, build your success. Time to level up and beat the stress. Get ready to laugh, land and eat. Your weekly scene. Let's go.
I gotta get this timing, man. This new song that they did. It's gonna take me a few seasons.
You know, Bobby, I was in the club last weekend and they were playing this song. People were dancing like crazy in the club.
I know. I'm getting some royalty checks. I got like 32 cents from Spotify last week for how many times they downloaded it on Spotify. I was like 32 cents, man.
People were like, Shazam, what's this song called? Shazam, who is this?
Oh, you know, it's nowhere near as good as my homie Jay Neal, but it's up there.
That was the encore. They played that one next. And
I could only imagine. I could only imagine. Guys, welcome to another edition of Laugh Underneath the podcast with my homie Jay Neal. Maybe we should just call you that for now, Jay Neal.
That's fine.
What do you think? That could be your pseudo name for the podcast industry.
I like it. It's mysterious. Yeah. It's provocative. I like it.
Provocative, and that lighting is very provocative behind you. If you're listening to this on Spotify or Apple Podcast, go to our YouTube channel, Laugh Underneath. First of all, go to our YouTube channel, subscribe, comment how much you like our show, and then check this Everlasting Sunset.
Yep.
I told you, see, this is an 80s song. You like, wasn't there like a song called Everlasting Love in the 80s?
Wasn't this, or it could be a sunrise?
No, it's the sunset. You can see the sun setting.
Or that's
I don't know.
Glass half full, Fabi. I guess you're a glass half empty kind of guy.
Well, mine is more of a tequila sunrise, but we'll go on to the topic. But anyway, listen, I don't know where James Kleiman is today. He was supposed to join us. Maybe he'll be coming here momentarily. We'll figure it out when he gets here. But there's a lot of stuff going on this week, man. In the news, it was like a barrage of mortgage news. Like, what the heck, man? It's like, I don't know if it's me or so let's talk about the pink elephant in the room. Mortgage rates. We're back up to where we were like last September, last August.
It's that darn oil.
It's the darn war, it's the darn unpredictability, it's the instability, it's people. But here's a catch. Okay, so I have never seen where there's been uncertainty and people have not bought bonds. Why aren't people buying bonds then?
Your lifetime, in your mortgage lifetime, is this the first you've ever seen this occur?
That I can recall, yes, because my memory's starting to fade on me a little bit. So,
like
the
sunset. Like the sunset.
Maybe that's why I see the sunset and not the sunrise. That's
Bobby's memory.
You've been messing with me, man. But seriously, I mean, normally bonds are your safe havens.
Not now.
Right, but also they're avoiding the 10-year bond. They're avoiding any kind of bond, right? The MBSs are sunk.
Gold? They're putting their money in gold? Is that where it's going?
I think it is gold. Gold. Yeah, I mean, but it's interesting because at a certain point, I'm just going to let James in here because he can join the conversation. How you doing, James?
Hey, how are you guys?
Ready, James? Here we go. Hold on. Ready? Here we go. All right. Now we know James is in the house.
That's a great intro.
It's not bad. Yeah, it's pretty good.
Well, we figured this out last season when we did some AI renditions of James, and I think if the famous word was "what the fuck was that?"
It might have been. Yeah, I've got a bit of a potty mouth. I try not to curse as much because I have a sick baby in the room next door.
Oh, okay.
And a couple months ago, I was putting him down, and like when they poop, they like roll like alligators do that like death roll, and just got shit everywhere. And in frustration, I yelled, "Oh, fucking baby!" And my 4-year-old hears me say,
"Oh no!"
So now every time anything happens with Henry where he's not doing something, he goes, "Daddy, you should tell that fucking baby." And I'm like, no. And so it's like the bane of my existence now. Yeah. So I'm trying not to curse as much.
All of a sudden, Child Protective Services show up and said, and the 4-year-old's like, "Where's that fucking baby? He's the one who got you in trouble."
That's right.
You're like, take them both. I don't want them.
Yeah, I get a lot more work done, honestly.
Listen, we are talking about the mortgage rates because they have skyrocketed, right? Like one day, one of my guys was quoting 5.6 on the 30-year. Next thing we know, we're like at 6.5. Now I don't know where we are anymore. Who knows, right?
6.8, I think, right?
I have no idea. But bottom line is what, in your opinion, I was telling Jay Neal here that I have not seen where there's been instability and people not seek safety in the bond market.
So, I mean, the first part of that is, right, Fannie and Freddie have been aggressively buying MBS. I think, there's a lot we just don't know about the Strait of Hormuz. And Fabi, I'm guessing you know a lot more about that situation than I do.
Strait of Hormuz is like way beyond yeah. I mean, talk about Karachi, Pakistan, I'm all in. I can talk about that all day long.
Okay.
You know one thing, I will give you guys a little scoop here. There are talks now going on in Pakistan with that they want to make this port called Gwadar the new port so that they bypass the Strait of Hormuz in the future.
Oh, that's interesting.
So they've been building a pipeline between Saudi Arabia and Pakistan for years, and they're about to open that up. So you don't need to go to the Strait of Hormuz and be held by the Iranians or whatever in that regime at that point. So they can bypass that. So there's a little mortgage scoop for you there, big guy.
I appreciate that.
Let's get into some dirt, because I want to talk some dirt real quick. I want to talk some.
Yeah,
right.
Go ahead.
Todd Screama, Summit Funding, was on the show a year ago. Said his company's doing great. And then you scoop out and said Todd's selling the company to Cross Country.
Yeah.
And Ron had said he's not buying companies anymore. He's going to just go after their top producers. So it's like you got two guys who make statements and then they collide with one another. How does that work out?
Can you believe that people might not be saying exactly what's happening in their business to people with a microphone?
I don't like that, because I feel like when there's a code of honesty there's got to be like something above. What's that saying? Like chivalry
among thieves.
Honor among thieves. Yes, that's what I was looking for.
That's one of the sayings.
Professional courtesy among sharks. Take your pick. I mean,
okay. Yeah, I don't know the last one.
Same.
Yeah, I mean, look, it's interesting because Todd's mentor also sold his company not too long ago, Jim Caffrini, and another kind of legend of mortgage banking ended up picking up that one, of course, Union Home Mortgage. And I don't have all the answers. I don't know all the reasons, but I had heard that Todd had been a little, not as present, not as active in the business in recent months. And the fact that, that they have been losing producers organically, let's call it. But, Todd Screama is still a big name in this industry. He's done a lot in this business. He has a lot of friends.
Platform with Rick Ruby and all that stuff. I mean, the guy.
That's kind of an interesting wrinkle to this new marriage as well, right? Kind of the core guys all getting back together, so to speak. I don't know under what context. I don't know either one of them, so it's not for me to say. But I do think Summit wasn't doing as well as maybe they would portray, and that's true of a lot of companies. Who wants to be like, you know what, we're doing real shit right now. I think we'll be lucky if we make it another year, right? No one's going to come out and say that.
And I remember when Todd brought those three guys from Movement Mortgage over. I can't remember their names. I know Shelton. I don't know the other two guys, right?
Darren and
That, I remember we were doing a podcast that day. I remember saying, like, he just put a target on his back. Like, to me, it was like, why would you bring over three executives? Because these guys are all going to have lawsuits behind them now, and you're not going to be able to take any of the movement people, right? But and
you were right. And what I hear in terms of my reporting over the last couple of weeks is that the movement settlements were significant factors in the decision to sell the company. Not the only reason, of course. These things don't happen in a vacuum, and also, for what it's worth, Todd did a really good job in managing to convince a lot of those branches to move over to CCM. And so, I know a little bit about how the deals were structured, not everything, of course, but they are going to be with familiar faces. There's another division that's going to be set out by Robert Vassar. So I mean, if you think of it like it's a lot of the same people who are just kind of formed under.
Did you report yesterday that there's like 160 people being laid off?
Mostly back office staff, and that pretty much always happens in any significant M&A deal involving mortgage lenders. Not always, but I'm sorry to say, but that's very common these days.
Yeah. All right, let's move on. We'll stick with Cross Country, and we'll add in Matt Ishbia, whatever his name is.
Matt Ishbia.
Ishbia, yeah. and this thing with the warehouse, with the servicing company, right?
Two Harbors.
Yeah. I don't know why I was thinking Dark Harbor, but it's Two Harbors. Dark
Well,
Harbor.
like, in private equity, everything is like choose a color, and then it's either a rock or a stone, and that's your private equity company.
Right.
Some body of water, and then some sort of number, and suddenly you have a mortgage servicer.
Is this like one of the last servicing companies that's available for sale? I mean, why are they fighting? Like, and now there's a third company that's interested in right? That even up that bid between Cross Country and UWM.
So I think a lot of this goes back to when Rocket and Mr. Cooper announced that they had a deal, and that is magnitudes bigger than any other servicer in America. And Two Harbors is really kind of a REIT, right? They're not directly competing in a lot of cases. They have Round Point, which there's a whole backstory here with Freedom, and they have a servicing platform. And so for Matt Ishbia at UWM, they were already on the servicing journey. I think the minute that it was clear that Mr. Cooper and Rocket were joining forces, that he was going to have to do something, because you can't have your closest rival be like, 15x in their servicing book over you, and that servicer having already worked your book as a sub-servicer, right? So I think that really changed a lot of the pieces on the board for UWM, and it was a signal to the entire marketplace, like, look, recapture and refi is like what the average homeowner is in their house, 7 to 10 years. Like, a lot of people bought in 2020. A lot of people bought in 2021. People have reasons for trying to tap out some of the home equity or even getting a refi. There's just a lot of money that could be up for grabs here. And often it's just the first one who gets to the borrower with decent terms. And I think if you look at like Freedom with their Govy book, you look at Mr. Cooper with some of their book, it's really, really, really hard to compete with some of those servers and servicers. And if you also think the broker channel also has historically really been a laggard in terms of refi production.
Yeah.
For UWM, you look at that and you go, okay, we really need to protect the book. The best way to protect the book is to get more MSRs.
Let me ask you a question. Let me just left field question. Wouldn't it be cheaper just to start your own servicing company?
Well, they're already doing servicing.
Right. Why is this dependence on buying this Two Harbor company? Any understanding of that? Like,
they were already, so they're acquiring MSRs, right? So they're acquiring actual loans that they can say, hey, we've got this MIA technology, we've got this voice AI, we've got this army of brokers who are not, they're independent, but they do send us a lot of their business. There's only a couple ways. There are only a few levers in servicing, right? It's like technology or scale.
Yeah.
And so you either scale up or you have an incredible technology. I think what UWM is trying to do, like, they've already switched over to MSP. Most of the loans are already in the MSP portal. Their servicing, their sub-servicer is going to be, no more at the end of the year. So it's
amazing to me that this is like getting such news. Like, so? I got in the mortgage business, like no one even knew who the servicing companies were. We were just like, who's going to buy the beer at the golf game?
And here's the reason, Bobby, and I'll make it really simple. It's because they're not thinking about it as an individual transaction, right? They're thinking about it as like, okay, I originate this loan and then I keep the servicing in-house. I make them a good deal. My economies of scale allow me to offer a great rate or maybe a good margin, depending on the client and
they're the life of the loan. I get it.
And then I get it again, right? And maybe I get a HELOC out of them. Maybe I get, some additional partnership with another company that I can use, or I can just collect more data. And more data means I have more bites at the apple with other customers of a similar profile. So I think this is just a big data arms race.
And if you don't Jay Neal, how many apples have you eaten so far up there in Minnesota? Anything?
It's been winter time. There's been no apples, Fabi.
All right.
Yeah, there's some icicles. I eat a lot of icicles. They are very low calorie icicles there, so you know.
All right, look, Mr. Kleiman, we did something for you because I know we freaked you out with the AI stuff, but I did this thing just for you. It's no video this time, but I want you to just hear this out. Ready?
Okay.
From Brooklyn where the headlines get cooked. James Kleiman, yeah, he wrote the whole book. Mortgage Scoop, yeah, the industry buzz. Not a press release guy, he report what it was. Breaking stories, yeah, he lifting that veil. What they say off record, he already got mail. Data-driven takes, markets rise or they fall. Hottest takes in the game, yeah, he covering it all. 2 kids, 1 wife, big cat on the throne. P.F. Chang roaming like he run the whole home.
Damn, that's really good. The AI shit is insane right now. It's really crazy what you can
That
do.
was Bobby. That's not that. That was all Bobby. He played all the instruments. He rapped. That was all him.
All right, look, we got to move on here, but thanks for joining us, man. I wanted to spend more time with you, but I know you got some more important stuff to work on. But
I got to go to my kid's school and deliver snacks. So
all right, buddy. Well, look, you run on. Have a good one. We'll catch up with you next time. Okay?
Take care. Thanks.
Man. See ya. That's the Mortgage Scoop, guys. All right, let's get on with the show here, shall we?
Yes.
What do you think? That was a good rap. I thought that was a pretty decent rap.
That was a very good rap.
He's got some big ass cat, like a 80-pound cat or something, called P.F. Chang.
That's a small mountain lion with that. That's not a cat.
I don't know. In Brooklyn.
He's confused. That is not a cat.
Brooklyn, man. Think about that. Just think about in Brooklyn. Let's bring out our guest for today, shall we, J. Neal? All right, Miss Melissa Langdale, where are you? There you are, Melissa. How you doing?
I'm doing fantastic, although I am a little jealous of both your intro and James's rap intro. So we're going to have to coordinate online how I can get a rap intro.
Listen, all you got to do is participate in the show of 17 episodes, and then boom, next thing you know, we have a rap song for you.
Okay, there you go.
And just FYI, I mean, Mr. J. Neal had his lawyers contact us because we used to not have an intro for him. And,
there was a song.
There. Shall I?
No. That's my lawyers talked to you about that. No more drunk.
So,
I got to take a phone call here from my lawyers. Right? And my therapist. It's a joint call.
So look, obviously now you know why we call the show Laugh, Learn, and Neat, because it's a little bit of seriousness with a lot of laughter, right?
I love it.
Anyway, Miss Melissa Langdale, founder, CEO of Praxis Lending Solutions. Welcome to the show. I know we've been trying to get you on here for a few times, and we finally got you here.
Yeah, thanks for having me.
No, and you are in Texas, right? Because I noticed something about you in our pre-show talk. Like when you got really passionate, your Texas came out.
I saw that. a little sneak in there, a little twang.
A little Southern, huh? It just, it sneaks in at the most inopportune times.
It was also, I was like, oh wow, she's passionate about this topic.
All the ums go away and all the y'alls come in.
So I mean, how is business? Is business okay?
Yeah, business is great.
Booming?
Yeah. I mean, look, our industry has a lot of change happening right now, right? And that's why I founded my company, is to help companies to navigate all of that change. So,
I mean, change is always happening though in our industry, isn't it? I mean, it feels like if it's not changing, you're not in the mortgage business, it feels like.
Yeah, I get it.
And I feel, I've been saying this quite often, and I don't know if it's my age or what it is. I'll be honest, I don't know if it's, but I feel like the last 2.5 to 3 years, we have hit some warp speed of change in our industry.
Yes, for sure.
It's been like this whiplash, oh my God, everything is not the same anymore. Do you feel that?
Yes, of course. Again, that's why I launched my company, is there's just so much change happening in the industry between technology and the evolution of what's possible right now. Also, consumer expectations are shifting drastically, right? When every other thing that they buy can happen instantly, why in the world does it still take us 30 days to get through the mortgage process, right? People are starting to go, okay, y'all have got to get this figured out.
Here's the first y'all, guys. I want you to note that. See, as soon as the passion comes in, the y'all comes in.
we need a y'all counter.
Y'all counter.
We will set one up for you the next time you're here. We'll set up a y'all counter for you.
I'll just hold my fingers up like this.
By the way, I'm in Virginia. I grew up in Virginia, and I was in Jersey one time during my college years, and this one girl says, "You have a Southern accent." I said, "Me?" Sorry.
Southern Pakistan? I don't know.
I mean, even then, I was from the northern part of it, so like I can't even, you know what I mean. But anyway, listen, Melissa's had multiple different roles in the mortgage industry. That's the one thing that I liked about her profile when I read it. One of them was you were at TCM, the mortgage TMC, right?
Yes.
You're like the third person now from TMC that's been, because we've had Rich on here, we've had Jody on here, and now we got you on here.
Yeah, there you go. You got the full circle.
We done? Is there any more TMC people left that I got to get on here?
I don't know. I don't think so. There's a lot of incredible people that are a part of the TMC world. So
yeah, I did my first TMC event last year in Boston. I don't think I saw you there.
No, I was not in Boston.
But I did see you in Dallas. That's where I met you, at the Housing Wire AI.
Oh, yes. That's exactly right.
Right? Who'd you go on stage with?
I was on stage with Latasha Wadi from NFM and Christy Sukamnet.
Yeah. And based on that AI conference, did you walk away with any nuggets?
I did, but mostly just different perspectives, right? I spent so much of my time like so narrowly focused on AI for mortgage that it was really cool to have an opportunity to have context into AI for real estate, AI for, so it was an interesting experience to see it from different lenses and maybe even think about ways that, we can better partner together.
Now this year, the gathering for Housing Wire, I know this is not a Housing Wire event here, but is in your hometown, right? In Austin.
It is. It's right around the corner. Yeah.
So Justin, did they ask you to come back and do your stand-up routine this year?
They did not ask me to come back.
Wow, that's not cool, dude.
No, I think it was too much. It was too much. It's disruptive. That's what it was. Yeah.
Did you bring up any like colorful jokes?
No, that's probably what didn't go well, is I didn't. I stayed safe. PG.
So just so you know, Justin is also a stand-up comic. And what he does is he actually does loans and they laugh at him because the rate's so high.
Hey, my lawyers are going to have a field day with you, sir. Just keep going, Fabi. Keep going.
All right.
That's awesome.
I got a question. I have to ask this. So you've got this amazing business, Praxis, but prior to Praxis, you had a great secure corporate role. You left that to launch your own company. Tell me about, is it scary? Is it exciting? Is it all the things?
Holy crap, all the things. Yeah, all the things. Anytime you launch into something on your own, for the first time, it's scary and exciting all at the same time. And sometimes hourly that changes.
What made you launch it though? What was it like? You were sleeping one night and you're like, I can't do this anymore with corporate America?
No, look, I'm incredibly impact driven. The reason I've been in this industry as long as I have is because I really have a heart and a passion for the impact that we have an opportunity to have. And look, I have this unique, like weird nerdiness where I have deep industry experience, obviously. And then I've also had bits and pieces of technology. And I just recognize that there's an opportunity for our industry to need a bridge between how technology has been built and how lenders can really leverage it in an impactful and meaningful way. And at the same time, if you remember back when I took my role at TMC, we were at like the peak from a cost of origination perspective, right? We were like $13,500 just to produce a loan. Mm-hmm. And that, comes from years and years and years of companies investing in technology and investing in their people. And, the culmination of the two, summed up to $13,500 alone. And so I have been kind of racking my brain for years on ways that we as an industry can lower our cost of origination, better impact our consumer experience, and help our companies to be more competitive and more effective and efficient. So,
so from your amazing brain, right? Just give me one thing that our listeners could take away and say, okay, this could reduce our cost over here.
So I think one of the reasons that our cost of origination is as high as it is, when you look at what that number is as a whole, about 70% of it is operational overhead. And yes, that's sales commissions, but it's also all of our operations.
Which is what, about 58% of that 70, right?
We won't go into that number. Nobody's changing their commission structure. Everybody wants their sales team super happy, right? So let's focus on the things that we can, work on controlling. And that's how our people and our technology work together. And so I think one of the reasons that our our cost of origination is as high as it is because we've been ineffective at how we've leveraged technology over the years. We have traditionally a process that was built for paper. When we used to mail paper loan files to people to underwrite, and then they would mail it back with a list of things we needed to get. We were incredibly ineffective and inefficient in our process, and yet we still close loans in 30 days. And we haven't been able to move that needle that entire time. So we've built our industry on this kind of manufacturing process that's very similar to Henry Ford's moving assembly line. And that process is really effective, like I said, for producing a physical product. But now our industry has the capability of leveraging data instead of all of these documents. And we won't ever get away from, not having documents altogether, at least not anytime soon, because people are still going to work, for their Uncle Joe, and they're going to get a, handwritten paycheck. And, there's always going to be those situations, right, that we have to be able to navigate as an industry. But the more opportunities we have to lean into data and less into documents, the more opportunity we have to rethink how we manufacture mortgage loans. And the best example I can give for folks in this is, everybody's talking about task-based workflows. How do we identify all the tasks in the process? And then how do we automate, the various parts of our process to try to become more efficient at what we do? When you take that approach to it, you're going to get incremental improvements, right? Incremental efficiencies. I think, and this is way easier said than done, so y'all bear with me. I actually think we can rethink how we manufacture loans altogether. So for example, think about income calculations, right? We at pre-approval get pay stubs and W-2s and tax returns, right? Well,
I have some loan officers that don't do that, by the way. That's the preferred method. I want to make sure we call that the preferred method.
In a world of unicorns and rainbows, you get pay stubs, W-2s, tax returns, or you get a VOE, you're part of that whole process, right?
Right.
Some kind of validation of income. But why do we wait until it goes through processing, and then it goes to underwriting, and it goes through all of those different people and all of those different queues to get it in front of the decision maker? And so in an agile workflow, which is what I spend a lot of time talking about, when the documents and the data are available, the decision happens. It's triggered to be able to actually make a decision on the income in the loan. And so this reduces our risk on loan as a lender, right? We find the hairiness of loans earlier, but we also are able to serve consumers in a more meaningful way when we're able to speed up that certainty that they're really looking for.
So when you bring that point up to the COOs and the IMBs, especially some of the COOs that I can see their steam just coming out of their ears as you were talking, right? Because they're seeing 6 miles down the road from this one decision that they make, right?
I know. Well, they're probably going, bless her heart. She's like,
what's the pushback? What is it? What you just said sounds so plausible and so logical and so reasonable. Why wouldn't they take that course?
Because it's so much easier said than done, right? Change is hard. We have LOSs. We have the core foundation technology that we leverage that's built to operate in a very specific way, right? So we're not, having to just design a brand new company and design a brand new system to go into something that's brand new that, we can intentionally move forward with, right? We're having to move our team and our technology in an impactful way. So it's a lot of work. You either have to relaunch your LOS or look at new loan origination that offer that. And literally every time anybody says that, they're like, yeah, good luck. Peace out. I'm done.
Justin, how about you? You still originate. I don't originate.
I do.
So, do you still use a LOS or a POS or
I use both. I use all the acronyms because I love acronyms. But as you're describing this, I'm just thinking, I think a lot of the pushback might be, gosh, that sounds expensive to make those changes, but that would probably pay for itself pretty quickly. I'm not sure where the break even is, but what you're describing is going to shorten timeframes, make file quality better, and take some pressure off the loan officer too. Right now, I'll take a pay stub and everything, and I'll send it into a scenario desk. that's a manual process that I do
Right.
more than I should because I'm not in the field as much. But I like where mine's going with that. That's definitely a shortcut.
Yeah.
Hmm. When you were building branches as like because you built branches for, right? You right? I imagine you've done that, right?
Yeah.
Were you seeing these improvements you could make for your sales team?
Yeah, so I mean, it's been a little while since I built a branch, but back then, even like we would focus on finishing early. So our key metric that we always celebrated was how many days between our CTC and closing.
Yeah.
So
Oh,
if we could average 4 days or more, like I threw a party for the whole office, and so we consistently were like 4.5, 5 days before closing. So, which is super fun, but that's the consumer experience that they're really looking for. But 5 days is no longer okay. Like people are looking for like that instant gratification, that way that they can see yes faster. And I think as an industry, until we start making some of these changes, we're always going to hold ourselves back.
You brought back such a huge memory, Melissa, where I remember this one boss of ours, I was a regional, and he took down like, it was awful because I don't want to name the company that was at that time, but they could sue Justin. But anyway, we were running like 52 days to close a loan. And this was in 2014 or 15. I can't remember the year, right?
Yeah.
It was really bad. It was because of different issues that were going on. So he literally took those days and said, okay, look, guys, our ops team only has the loan for 12 days. The rest is all on sales.
100%.
And when I saw that, I was just like, oh my God, like, why are my loan? So Melissa, have you like dug into like, I mean, I know this, like,
yeah.
Why do loan officers like and clients, I mean, if they want that experience, they could actually enhance their own experience by giving us the documents quicker? I mean, is that a simpler way to say it?
So, well, of course, right? This is a big part of what I do for lenders is I'll actually dig into the data behind every part of their process and timeline, how long everything is taking throughout the process. And you're right. I mean, most companies, it does depend on their structure and how complete they want the file when it goes in and all that sort of stuff. But between 7 and 10 days is the front end of the process where the sales team has it. And that's gathering documents from the customer. So, sometimes it's that we're really nice. We're like, yeah, just get it to us when you have an opportunity to get it to us. You're not closing until another, whatever. So whenever you get it to us, that's perfectly fine. In a more like digital streamlined way, they actually would connect their bank account information, their payroll information during the POS process. And all of that would already be there. We don't even need anything from the consumer at that point. And again, once we have data and documents, we can issue decisions. And so I think, again, unicorns and rainbows, not everybody's payroll provider offers it. Not every bank is, but a larger percentage of them are. And so if you can get 80% of your loans through a digital process, like, why are we still doing verbal VOEs?
So that brings up something that Justin's really afraid of.
Okay.
Is the sun setting on loan officers.
Y'all in the sunset.
I am afraid of that. I'm afraid of that. He's not wrong.
I mean, so does that begin to then creep into that goodbye, Mr. Loan Officer? Thank you for business development. That's where we really need you then.
Yeah, I think it's healthy for us all to recognize that all of our jobs are going to change.
Okay.
And so I think the more we talk about like, no, we're all going to be happy unicorns in the next, 2 years, like it's going to be a ton of change, and it's okay for us to lean into that. And it's okay for us to be uncomfortable with that as an industry together and figure this stuff out.
Yeah.
I think it's just really healthy for us to talk about the fact that all of our jobs are going to change. The way that we have traditionally been a loan officer in the past might change then, and that's okay. People are going to come to you further up the sales funnel because they've been talking to ChatGPT about all the loan options that they have available, right? And then ChatGPT is like, hey, he's the best guy in your marketplace. You need to actually go call him. And then they come to you and they're like, hey, I need a conventional loan. Here's my income, assets, credit. Like, they're already giving you everything you need now. So when they come to you and they're further up the funnel, like you're your mindset has to shift a little bit, right? You have to be able to figure out how to still make a connection with that customer and to build the relationship so that you're the trusted resource that they need. And so, but I will tell you, I believe this is like the oldest saying in the book, like people will always do business with people they know, like, and trust.
Yep.
I think this is why it's so important for us to have conversations like this, is because the more conversations we have as an industry around the right places for people to live and the right places for technology to live, the better we're going to be at navigating the consumer experience and meeting them where they really want to be. So I'm obviously very passionate about this. I don't think officers are going away. I don't think that that's going to happen, but I do think all of our roles are going to change.
Justin, real quick though, I want to ask you something, because you're also recruiting. You also recruit for loan officers.
That's my day job. Yeah.
Yeah. So you put on two hats.
Yes.
I mean, so when you recruit, I mean, obviously compensation comes up as a topic when you're recruiting. So if you told somebody, well, I know you get 150 bips right now, but I just need you to do these two things, so I'm just going to pay you 70 bips.
I've never said that before. I've never said those words before. And I want to kind of kick it back to Melissa, because I think so if you could tell the loan officer persona that's 58 years old, he or she is maybe tech adverse or tech challenged or tech wary, what would that person do to ensure that they got 10 more years in this business? What's the one thing they can do today, tomorrow, and forward to stay here and be still producing? They
need to invest in knowledge around AI, and they need to add that knowledge to their partners. And the reason that I say that is because, look, there's the speed that AI is evolving all the time, the tools that are available to them, but also the tools that their referral partners are using, the tools that borrowers are going to expect is also going to be changing. And so, like, invest in yourself. That's okay. I always, when I used to originate, I had a business planning team that used to tell me, like, 70% of your time should be, spent in out, like, growth activities, and then you've got in time and on time. On time is like your time that you can spend planning, right? It's the time that you invest in yourself. It's the time that you have an opportunity to invest in your leadership skills and your, in this case, technology skills and all of those sort of things. That shift, that balance between growth and in and on time might shift a little bit, short term, but that's okay. If they're uncomfortable with it, I think they need to lean in and find some people around them that can help them to navigate that.
I want to give my advice. I want to get your piece of advice too. My advice would be do what Melissa just said. Also, you got to be Johnny on the spot, because I think right now, if I've got a client in my pipeline that I'm not talking to very often because I've lost track of them, they might be on AI making a new best friend. And so I got to make sure I'm reaching out, doing the traditional things I should be doing that I've gotten lazy because of COVID and I didn't do. And be everything for everybody at all times, which is really hard to do, but that's my advice. Fabi, what's your advice? What's your takeaway?
I think I've been saying this since 2019, so it's really odd that I've been saying this, but it's the absolute truth. In fact, I said it because I forget the guy's name, but the guy from Expedia had come in, and I think he got in with Zillow or whatever, and the whole thing was they were now going to be forming a mortgage company, blah, 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 and everyone was scared that we're going to lose our jobs in 2019, right? And I said, listen, when I'm on a plane and I get hit with turbulence, I need the pilot to come on and say, hey, guys, I talked to the plane that's ahead of us. They said it's going to last for about 20 minutes. I'm going to try to get us up to 30,000 feet out of 28,000 and see if we can find some smooth air up there. That's the loan officer. That's what we need to be communicating with the borrowers.
Yeah.
And that communication is so critical at this point. I don't care what age you're at, whether you're 58 or 28. If you're not making your borrowers feel comfortable with the decision they made, you're going to lose them, because they can just go to any company online and get no communication at all.
Yeah. Well, and I think there's a component of that too, that is kind of the art of structuring too, right? We've, as an industry, it's real easy for a consumer to come to you and say, hey, I want a 30-year fixed rate loan. Well, how long are you going to be in the house?
Mm-hmm.
That's your opportunity to pivot and add value to the conversation and show why you're the professional to really be, their partner through that process.
Like even today, Melissa, I mean, the rates are spiking, right? I think we just got a lock alert from Barry, right? He's like all red caps coming in, lock, right? And so it's kind of like, when you're sitting there with the consumer and you're taking a loan app, you have to now be able to tell them, look, we're in a market that's really volatile. And if you're happy with this rate, I would tell you to go ahead and lock. and not gamble with the market, because I don't know what'll happen between Iran and America and Israel over the weekend. They might find peace, or somebody might attack somebody's island. Who knows? You know what I mean? But it's like, I would just go ahead and lock the rate in today.
Yeah.
And that kind of advice is just needed.
Yeah, it is.
So anyway, all right, I'm off my high horse real quick. Melissa, I gotta ask you this thing. You're talking to a lot of different companies, you're getting, I mean, you get to experience different cultures, different vibes, different leaderships, right?
Yeah.
Like the best leader, what are they doing? What do you see that the best leaders are doing?
Oh, wow. That's a great question. I don't know that anybody's ever asked me, but I'll say the ones that are most effective at driving change, because that's kind of my sweet spot that I live in with a lot of leaders. They're leaning in to putting a group of change champions together for the organization. So they're establishing kind of an innovation committee or a change champion committee or a vision committee or whatever they want to call it, but a diverse group of people across the entire organization that are willing to lean in and be uncomfortable through all of those changes and help the company to understand the pain points that are seen at every part of their process, every part of the organization, and then help be part of the solution on how those pain points can be solved through automation, through AI, through various technology or process changes. And then take that feedback back to the team, right? And help them to get excited about it, help everybody to understand how change is being prioritized and how that change is going to impact their world. So I think, maybe establishing those change, having intentional change champions within the organization makes a huge
So obviously the opposite of that would be someone who's not doing all that.
Yes.
And like hiding behind the desk, not answering people's emails, not right? Thinking that everything will be okay.
Yeah. I had back in the day when I was a kind of area manager, we had this event that we did for realtors. And this was just when like the text polling thing was coming out, if y'all remember. So this was a while ago. But I had this video, like TV screen that was up, and we asked everybody to text in their answer to our question. It was like, what's the perfect type of loan officer? And it was like the always available, the underwriter brain. And then my last option was like the hide behind the rock when things get tough. And we did get a bless your heart vote for that one, but it was just really funny to have an opportunity to see. Nobody likes that, right? Nobody. That's not who or what we're.
Oh, that's funny.
I mean, I think leadership, you need to be out front.
100%.
You need to be the guy that takes on or girl, sorry, you know what I mean, but the person that takes on the challenges head on and not be afraid of it, because otherwise, I've always told people, and Justin, I mean, once again, I know you're out there recruiting. Like, I tell people, like, if you're paying somebody portion of your revenue, what are they doing for you?
Yes.
Are they telling you what's about to come down the pike, or are they just waiting to react?
Yep.
Because okay, Melissa, here's another question, right? How many times do you walk into a company and just see that they've been reacting for the last 5 years to what's happening?
Look, it can happen for sure. It's easy to happen, right? It's easy because we all have things that pull our time and attention away from the things that, help us to intentionally move the company forward. So it's common in every industry. It's common in ours too, but it's also understandable why it happens.
No, I mean, I'm not trying to make anybody feel bad. I'm just saying, like, a lot of companies have been reacting instead of being proactive. And I always find that the leaders that I'm more attracted to are the ones who can see, like, where we're heading.
Yeah.
And they could be wrong, but at least they saw something that they acted on.
Yeah.
And didn't wait for it to set me up so that I was unprepared.
Yep.
Man.
What's wrong, Justin?
That just hit home. That just hit home because, and you guys are both on point with this, because it's such an easy thing to sit back and see how things play out. It's actually safer that way, I think. And it's scarier to lean in and be forward thinking. But in this, especially the last couple of years, I feel like it's the forward thinkers that are going to win in the end.
Yeah.
There's a widening gap between those that are investing in change and investing in innovation, and those that are waiting.
I was with where I was in Dallas with the Ingenious Data, Jeff Walton.
Yeah.
You know Jeff. Everyone knows Jeff. Everyone knows Jeff, right? He's my buddy, right? And we're at some company's event, and they were talking about they had just saved 9% of the cost of origination based on the new technology that they implemented over the last 12 months.
Yeah.
And I'm thinking to myself, 9%, and I think they had done 13 billion last year. So just think about 9% of that revenue that they just saved. In my mind, all I saw was the gap getting bigger.
Well, think about the impact that that has on the loan officer, right? Today, when you as a loan officer come to your leader and say, hey, I need this pricing exception, right? I'm competing with a broker. I'm competing with, XYZ in the bank or in the marketplace, and I need help. Like, as a leader, you now have the ability to better respond and be more competitive. As a loan officer, now you're able to have that same kind of response and be more competitive in the marketplace. When you lower your cost of origination, that translates into more opportunities.
Yeah.
And so it all goes hand in hand. We think about this from an operational perspective, right? We think about, all the operational efficiencies that we can have, but that can absolutely translate to value in the market.
I mean, not only that, but then you can also reinvest that 9%.
100%.
You can reinvest in different avenues. You can take different chances with different technologies that maybe could work, maybe not work. You could do all. There's so many different the amount of income that's saving the top lenders, and it's just to me anyway. So we could probably do another whole episode on that. You know what I mean? I'm going to ask you this closing question here, because there is change, there's positive change, but is there something out there that the industry is ignoring? Is there something that is on Melissa's radar you're like, hey guys, like, I see this coming. You guys really should be aware of this.
I don't know about ignoring, but maybe just not hit the radar of everybody yet. I think AI governance is a very real thing.
Okay.
There's various types of AI that need various types of governance. And we as an industry traditionally has been able to roll out technology, and we get reps and warrants behind it, and we expect it to work because it always has worked, right? When we start to lean into generative AI solutions and agentic AI solutions, and we start to put those in front of borrowers, or we start to put those in parts of our process that are capable, making the technology capable of making decisions for our organization. In both of those cases, we have to have oversight and governance over that AI solution to ensure it's not unintentionally putting us in a position of UDAP concerns, fair lending concerns, ECOA, all of those things that we have to be able to control from a borrower perspective. And then the same thing on the decisioning component, right? If we're going to leverage that for a decision in our loan process, how are we able to say, hey, we are more accurate at approving borrowers over time as a result of leaning into this, right? Or did we unintentionally deny somebody because we've only trained our models on blue gorillas, for example, right? And so it knows how to approve blue gorillas, but it doesn't know how to approve green guinea pigs. I don't know where all this is coming from. But you know what I mean? There can be unintended consequences of things like that we as an industry have to be able to understand and control for as we start to roll these things out. And you saw Freddie Mac put a line in the sand and say lenders are responsible for this, not the technology companies. It's lenders' responsibility. And so I think this is where we're going to have to start seeing people leaning into different levels of oversight and governance.
Yeah, the reps and warranties part, I think a few weeks ago, maybe 10 days, I don't know how long, but Better came out and said, hey, we just underwrote our first with the right 58 seconds, or I forgot what they said, right? And we're all like, get out of here. But the first thing I thought of was reps and warranties.
Yeah.
Well, like, who is going to do the reps and warranties on something that was done by AI agent?
Well, let's think about what's really possible, though, because frankly, it's possible almost to get an instant CTC today. And it's empowered by Freddie and Fannie. When we get reps and warrants on income and employment and assets, and you get a property inspection waiver, a value acceptance, right? We've now cleared the borrower, the property, the assets, like everything except for title. is done at that point in the process, right? And so we have the capability of doing some of these things. So if you get that unicorn loan, everybody could underwrite it in 48 seconds today, right? It's how our systems are built and how our technology is built and how we communicate that value proposition to the marketplace that really sets us apart.
But then, and I hate to bring this up because we're coming up to the end, but then I always think like, because my entire journey of lending was always serving the underserved. Yeah. Even at Carrington, we actually coined that phrase. You know what I mean? When I was at Carrington, like we went like at that time when no one was going below 660. It's like 2012, 2000, and we said, okay, we'll go down to 550. And it was one of the greatest moments of my career where I was able to propel that whole thing. And then we started that whole serving the underserved movement then. Doesn't it feel like those guys will no longer be served at the same level if we are just because you say like we're used to underwriting blue gorillas. Sorry, you're a gray gorilla, and now you got to wait in line for 82 days.
You're 100% the reason why it's so difficult to do what I'm saying, right? So you're the out of the box, kind of scenarios. Look at all the things that just changed for condos, like this, for example, right? So all that change that happens, number one, but also all those different scenarios that come up, that's why that unicorn of a loan is a unicorn. It's extremely rare to get reps and warrants in all of those areas because everybody's financial situation is so different.
But Melissa, I have to ask you, if the guardrails could be put into place, could AI do a better job to represent the underserved than the average loan officer has done traditionally over their time?
Maybe. And the only reason I say maybe is it all is dependent on the data that the AI is trained on. And so if you had a big enough data set to where it really could consistently make good decisions at that, on that pool of borrowers, absolutely, because there's no bias in it. It's all looking at the data behind that borrower's. So yes, it's 100% possible for that to be the case. But I
think the bias is really what you just hit on. I mean, that controlling the bias from the human element is the hardest part for any of us to get anything that's below the radar or below the outside the guardrails approved. But I mean, it's like they still deserve a loan. And so, but it may not be the best candidate in the world, but it doesn't. There was actually a study, and I can't remember what year it was, where people with a higher credit score were defaulting more than the people with the lower scores.
Oh, that's interesting.
Yeah, because the people in the higher scores were having, businesses go bust, whatever, and also but the ones in the bottom were really budgeting their money. And
they're working their job.
Payment. The good news is in all of that, so a lot of those borrowers go through like FHA loan programs, which still requires a chums. Yeah. I know AI can pass the bar. I'm sure it could probably, go through the process of getting test cases and getting approved, but it's not there yet today where we still have people that are involved in that process. But.
Melissa, if people want to get a hold of you, where can they find you?
Oh, they can find me on LinkedIn. Find me just Melissa Langdale on LinkedIn or check out our website at praxislending.com.
And if you want to avoid Justin Neal, just don't come to the show, right?
Hey, can I plug something?
Of course you can.
I've got a comedy show in Duluth tomorrow night at Mr. D's Bar and Grill. Stop on by.
Where's Duluth?
It's in northern Minnesota, right by Lake Superior. If you're nearby, swing on in at 8 o'clock. Enjoy the show. No, we got to go. Cut the commercial. Cut the commercial.
All right, Justin, we'll see you next time.
Talking leadership, making the big plays in the mortgage game through the sun and the haze. Close more deals, build your success. Time to level up and beat the stress. Get ready to laugh, land and eat. Your weekly scene. Let's go.